Hey there, let's continue our discussion on IFRS 18. So the next section would be comparison between IFRS 18 versus the previous IAS 1. So this will be just a very overview comparison. I'll not go like line by line detailed comparison or anything. It's just touch basing on all the items. Okay, just a very overview level, very purview level. So the transition from IAS 1 to IFRS 18 involves both conceptual and structural changes. So some definition-wide changes are there, some just structure changes are there. So while the principles of fair presentation, going concern and everything are still intact, the presentation format and disclosure expectations under IFRS 18 are much more prescriptive. Means what, sir? Format is more detailed and the disclosures are well, defined. So previously IAS 1 was only presentation of financial statements. IFRS 18 is presentation and disclosures on financial statements. So IFRS 18 obviously focuses more on the disclosure expectations are more prescriptive, right? So if you see the key differences between IAS 1 and IFRS 18, before we even start IFRS 18, this is just to give you an overview of what to expect. Okay. So the first one, income and expenses categories. Under IAS 1, there are no such categories. Like you have your format, revenue minus cost of goods sold, gross profit minus SG&A expenses. So there is a standard, simple. But so there are no, not explicitly required, no categorization is there in IAS 1. IFRS 18 on the other hand, 5 clearly defined categories, or I would rather call them subheadings. Okay. So 5 categories are mandatory. For every company, these 5 categories should be there on the profit and loss. Okay, what are those 5? We'll talk about it. Subheadings, subtotals, whatever you want to call it. Then subtotals, sir, IAS 1 had no mandatory requirement for subtotals. It is optional. Like for example, gross profit, PBIT, PBT, PAT. These are all what? These are all subtotals. These were not mandatory under IAS 1. This is a recommended approach, but under IFRS 18 they are not optional anymore. They are mandatory subtotals. Like operating profit, PBIT is mandatory, everybody should show it, no exception. Okay, next one, performance measures. So this is purely for SBR students. DIP IFRS and FR students may know it for general knowledge purpose. SBR students pay main attention to this. So performance measures, there was no formal guidance available under IAS 1. What are performance measures? Like I mentioned previously, EBITDA or any other elements that you have that you can see on the P&L. Let me just search for a small meme. Yeah, this was one of the memes that was really interesting. So you can see adjusted EBITDA, what the management would show. They make certain adjustments and show it on the management commentary section, the board of directors report. Adjusted EBITDA, look, see how fulfilling it is. Actual EBITDA, not adjusted, unadjusted, pure EBITDA is just 4-5 years. Net income is just nothing, right? So that is one meme that was there. And then there is this adjusted EBITDA looks so handsome and all, whereas the actual EBITDA is like this, or else EBITDA is looking like Rachel Green, oh my god, Jennifer Aniston. Okay, versus free cash flows, actual cash flows are not there, or else this could be another meme, adjusted EBITDA versus actual EBITDA, or you get the idea, right? So adjusted values, or this are what management would show, they are not appropriate, they are not really accurate. We are profitable, be honest, I'm being honest, does your business make actual money? It's adjusted EBITDA, thank you. So EBITDAs and adjusted EBITDA, so these are all what? They are all performance measures, management performance measures. They can manipulate it as much as they want. Earlier under IAS 1, because there was no guidance. Under IFRS 18, they must be disclosed and reconciled. Here is the key word. I love this word. Now reconciled means when they say adjusted EBITDA is 100 million, net profit is 5 million loss. Sir, adjusted EBITDA 100 million profit. Net profit is a loss of 5 million. So what needs to be done? So now whenever they present adjusted EBITDA as a management performance measure, MPM, they should show a reconciliation. So net profit is minus 5 million. How did they come to plus 100 million? What are all the additions and subtractions they did? They should show a reconciliation. Now there is less possibility to hide something from the users, right? So reconciliation is nice. It's the nail in the coffin. Like, don't do it. Simple. Okay. Next one, disaggregation. So earlier it was based on the judgment, whether you want to aggregate something, like club some items and show it as one item, or you should show separate items. Earlier it was purely on judgment. Now also it is judgment only, but it is required when the items differ in nature or function. So what is nature and function? I already explained that. Don't worry, it is there in the material. It would be there in here. Presentation by function, presentation by nature. I already covered everything in the material, so just wait. Okay. Next one, industry specific guidance. IAS 1 was having a very limited guidance on industry specific, but under IFRS 18, banks, insurance, and all other industries, there are more detailed guidances that are available. So these changes are expected to improve the consistency, analytical value of the financial statements. They help you benchmark across the companies, across different sectors. So now it becomes more uniform and standardized. Uniform, comparable, standard, whatever you want to call it, right? That is the purpose of introducing IFRS 18 to replace IAS 1. Okay, so with that, I'll close this second lecture. In the next video, we are going to talk about the most important and the most critical aspect of IFRS 18, the 5 categories of incomes and expenses, or subtotals, or whatever you are calling it. All right. So I'll see you in the next video. Keep smiling. Take care. Bye bye.